This video will discuss the accounting for treasury stock. When a corporation buys back its own stock off of the market, it is called holding it in treasury. So any stock purchased back from investors is called treasury stock. Assume on May 8th, ABC Company purchased 2,000 of its own shares of stock in the open market for $8,000. Total number of shares times the $4 per share price that it paid gets them to $8,000. Cash is credited because cash is used to buy the stock, and the $8,000 of treasury stock is debited into an equity account titled Treasury Stock. Treasury stock is shown as a reduction in total stockholders' equity on the balance sheet, which makes sense when you consider when owners purchased the stock, equity increased, but now that it's being purchased back off of the market, it is decreasing overall stockholders' equity. If the company later resells that stock, June 30th, ABC resold 100 shares of its treasury stock, and they resold it for $4 per share, which was the same price it had paid for that stock originally when it was purchased back off of the market. Total cash received is $400, 100 shares at $4 per share. And if this is stock, treasury stock, being resold, the amount of treasury stock held in treasury is decreasing. So we are going to credit the treasury stock account for $400, decreasing that account. When the corporation resells some of its treasury stock above its original cost, ABC resold an additional 500 shares of treasury stock it had purchased, and it was resold for $8 per share. Recall, when they purchased that treasury stock, they originally paid $4 per share. Total cash received is $4,000, which is the 500 shares sold at $8 per share. They decreased treasury stock at the cost or the original purchase price. 500 shares at the original cost of $4 per share, $2,000. So treasury stock is credited to decrease it $2,000. The difference between the amount it is sold for, $4,000, and the original cost, $2,000, is additional paid-in capital on treasury stock of $2,000. So it is recorded into a paid-in capital and excess account on treasury. If treasury stock is sold below what it had been purchased, ABC Company resold the remaining 400 shares of treasury stock, but they only sold it for $1.50 per share, and they had originally purchased it back off of the market at $4 per share. The original cost was 400 shares at $4 per share, $1,600. So they are decreasing treasury stock at $1,600. Because the stock had been recorded in that account at $1,600, it comes out of that account at $1,600 or $4 per share. The actual cash received was $1.50. $600 received. Cash is debited $600. The difference between the cost that had been paid for the stock and the cash received is a deficit of $1,000. Generally accepted accounting principles tell us we are going to use whatever paid-in capital in excess on treasury stock is available to absorb that deficit. So we are decreasing the paid-in capital in excess account by the deficit of $1,000.